All right, Ken Orange Theory Trader back with you with another video talking about sniper swing trade entries with the candle range theory. So let's not waste time and get right into it. So we have to remember that the profit potential. I wanted to start with this because I wanted to show you the potential of using this method and then going into what the actual method is. So when we're swing trading, you really only want one max to trades a week, and we're aiming for a 1 to 5 risk to reward ratio. So if you're getting 1 to 5, what's going to make this worth your while is to make multiple entries. That's what really makes it worth it. So for example, let's say you just start out risking $5 per entry. You're risking $5 to make $25 per entry. So with one trade, that's going to be worth $100. But we have to remember to think long term. So if you're risking $10, 20, 40, $60 per entry, obviously you see the profit potential there as your account continues to grow. Or if you have a funded account, obviously these numbers will look different to you. However, that's what you would be looking at. So let's get into it here. All the charts that I'm going to show you are going to start with a daily chart, and entries we look for on the 15-minute chart. So this is in correlation with the weekly expansion. So if you're not familiar with what I mean when I say weekly expansion, you want to pause this video and go back to the video just before this one that talks about the weekly chart and trading the candle range theory with the weekly profile or the weekly chart, how to swing trade with that. This video refers to that one. This is the basic diagram, and this is the pattern that we're looking for. Okay, we are candle range theory traders. So all we're looking for, if we're doing a classic expansion week, is we come to the chart either on Monday or Tuesday, and we're looking for Monday or Tuesday to sweep the prior low of either Thursday or Friday of the prior week, or we're looking for Tuesday to just sweep Monday. And if it also sweeps last Friday, that's fine too. And then same for the opposite direction. This is a long example. So this big candle here is like a week, and these are the daily candles that make up this weekly chart. And so this is a long example, and this is a short example. So once again, we look for Tuesday to sweep above Monday. Sometimes if there's a Friday candle from the week before, it'll sweep above that one too, and then close below them. Okay, so we always pay very close attention to how each day's candle closes. So you see how this Tuesday candle closes above Monday, this Wednesday candle closes above Tuesday, this Thursday candle closes above the high of Wednesday, like that. And same in the opposite direction, below, close below, close below, close below. That's part of our confirmation. So on the classic expansion week, it's always best when the prior week has had an expansion week in the opposite direction. And all that means is this type of expansion week will lead to this. If you see this last week, you're looking for this next week. Okay. If you see an expansion week like this last week, next week, you're just looking for this. I hope that makes sense. Okay. So if you see this, just look for this. If you see a long one, then try to go short. If you see short, try to go long. But the trick is that if this doesn't play out by Tuesday, then chances are it's just going to continue to drop if you're trying to catch a reversal. Or if you don't see this play out by Tuesday, if you're trying to go short, it's probably just going to keep rising. Okay, so I hope that makes sense. If you have questions about that, they'll just leave them in the comments. So let's get into it. Here's the first example here with the classic expansion week. This is a bullish example. So this is the daily chart. This is Monday, Tuesday, Wednesday, Thursday, and we don't expect much on Friday. So we see how Tuesday goes below Monday's low and closes all the way up here above the low of Monday. Okay. This is our entry window right here. So let's see now, because we always want to enter around the low of the prior day. So let's see how this looks. So we drop down. This is the whole week on the 15-minute chart. So this chart right here is just this. So now let's see, where is our entry? What time is it? What time does it take place? It gives us a fairly large window between 5 a.m. and 8 a.m. Most of these trades take place between London and USA session, but I'll put the times on here. These are all Eastern Standard Time. Okay, where we see where price dipped below the prior day low and then closed above. It consolidated a little bit, came back down and came back up. So all your entries should be in this little window right here, as close to the green line as possible. And we did get a 1 to 5, whereby we had a 30 pip stop loss and a 170 pip take profit. And if you're doing the classic expansion, typically you want to take your profits, whatever you get, by about Thursday around USA session, London or USA, depending on how far the price rises. Okay, but again, Tuesday between 5 a.m. and 8 a.m., that was our entry window. And then price just spikes up. It consolidates quite a bit. on Wednesday, just doesn't do much. But then Thursday is payday when you start to take trades on Monday and Tuesday. All right. Next up, we have a short example. Now, this is what I was talking about when price can poke above the prior couple days highs or lows. In this case, because this is Tuesday, notice how it took out. Of course, it was already above Monday, but this is last Friday, and this is last Thursday. Okay, but it went above Thursday's high, which was the high of the week, prior high of the week right there. Bang, went above that, closed down. It closed beneath these two lows right here. This is Friday. This red candle is last Friday. This red candle is last Thursday. It closed below the highs. When it does that, that is a great sign because we do not expect it to make another high. And then if we got in up here, boom, big drop on Thursday, and that was it. So in this case, Thursday would have been the best payday because price spent the rest of the week retracing. So that's why typically 1 to 5 does it good. But this was a case where you actually got 1 to 10. So this daily chart, now we drop down to the 15-minute, okay? This is Tuesday. Our entries would have been at about 7:45 or so. Right here where price goes above the high, closes back inside of it. We start to scale in right in here when price really starts to drop, and that's it. I say anywhere from 3 to 4 entries if you're good, but whatever your margin or account size does allow for. Straight drop, a little bit of a retrace, and then boom. Wednesday was payday here. You want to be out here. You always want to take the meat of the move. Okay? Always want to take the meat of the move. So between 1 and 5 and 1 to 10, 1 to 10 max, this was a great trade for a classic expansion candle. All right, for the week. So prior week highs on Tuesday, if it sweeps above, once again, for this types of stuff, if it takes out last Friday or last Thursday's highs, great example. But again, as late as Thursday, okay, Thursday and Friday, if it sweeps above those highs and closes beneath them, expect a large move to the downside the following day. Okay, next we have a bullish example, but this is a Monday trade. So notice how Monday swept both Friday, this was last Friday, and this is last Thursday. It swept below both of these lows. So what we're going to do is key in on Thursday's low. This is only for Monday though, okay? And just look at the last 2 days, all right? 2 days like max is what you're looking for, 2 to 3 days, all right? So this is Monday. It's just a doji. It's hard to see because the price really didn't move all that much, but it still stopped out anyone who went long on Thursday and then boom, expanded to the upside. So let's take a look and see where our trade was for this Monday. So this green line right here, that's last Thursday's low of day. Okay. So price really just chopped around. It didn't do much on Monday, but then it closed up here. Right, it closed up here for the USA near the USA session. So the best entries would have been around 1:45 a.m. to about 5:45 because you see all this consolidation. It didn't do much. Okay, it's just building contracts and then starts to trend very nicely for the rest of the week. You could have got anywhere from 1 to 5 or 1 to 10 on this, but you want to start to scale in around here. This is around the 5:45 hour. Build your positions right here. Literally no drawdown. Look at that, nice clean trend. That's what we like to see when we're doing these types of trades. All right. So that again was this. Okay, so with this price action I just showed you took place on this day where we played off of last Thursday's low. So on Monday, monitor Friday's low and Thursday's low at the latest and see what it does there. Okay, so that's just for Monday though. Let's keep going. Next, we have some midweek reversal examples. All right, now this is Wednesday only. So we have a concrete plan what we're doing on Monday, Tuesday, and then Wednesday. Wednesday, we're looking for the straight up reversal. So what are we looking for? This is the chart. This is our pattern. Wednesday ideally sweeps below Monday and below Tuesday and closes above them. Okay, for a long. So Wednesday is the primary day. It should take out anyone who went long here. This again is the weekly candle. It opens, it starts to go down 2 days, then one last final push low, and then boom, expansion to the upside. Midweek reversals can pay very handsomely if you catch a good one. So once again, for a short example, price opens right here. See this corresponding Monday candle. It goes up a couple days. Wednesday spikes up and then closes down. So let's take a look at some real examples. And just a note, it's always best when the last 2 days high or low are swept. But again, this is only one day. So in theory, if you just want to trade once a week and just only trade midweek reversals on Wednesdays, that's more than fine. And then you're just looking for one pattern, these. Okay, one long, one short. Okay, you don't have to trade all of these. Just if you just want to do one and focus on that, That's fine too. So let's take a look at some real examples. So this again is Monday, Tuesday, this large red candle here. This is a little bit of a different spin on it because we don't see where price, this was a long one. Price, this Monday candle was not red. It didn't start down. It actually started going up. Price opened up, but then it went down. The midweek reversal comes into play where price took out Monday's low and Tuesday's low and closed above them. Okay. So our entry is going to play off of Tuesday's low. That's still the main thing because let's go back to our chart. When we're long right here, see this Tuesday candle and this Tuesday low, we're looking to play off of that on Wednesday. So your trading level is already built in for you. There's no guesswork. All you have to do is just wait for price to go below Tuesday's low, close above it, and then monitor the daily close. Where does Wednesday's candle close? You have to ask yourself that when you're doing midweek reversals. Okay. So let's take a look. Where does Wednesday's candle close? It closes above the weekly open, which is awesome. And it also closes above the lows of the last 2 days. That's a strong indication that price is going to continue to the upside. All right. Now, this one was tricky because as you can see, Friday it did come back. And on our example here, Friday did give us another expansion. So while this is just a framework, nothing is guaranteed in trading at the end of the day. Okay. So that's why I recommend 1 to 5 risk to reward, because you would have got that had you stuck to that rule and wouldn't have to worry about this. Because when you get in here and price closes all the way up here, your profit target should have been hit. And we'll take a look at that now. So this was our entry right around here at 9:30. Was the first entry. It gave about an hour's worth of time for you to get in. These little lines here just show where you possibly could have scaled in. Price went up. It did come down a little bit on Thursday and then boom, took off. I don't know if this was news related or not. It's possible. I don't know on Thursday, but that's just how the trade played out. So when you see large, sharp moves like this, I mean, that's good enough for me right there because that's your 1 to 5 and what, 1 day, and that's it. You're done. Okay, so you always want to take the meat of the move. So that was that one. Okay, so next we have a short example of a midweek reversal. So again, we have Monday, Tuesday, and then Wednesday. What do we want to see Wednesday do? Sweep above the high of both Monday and Tuesday. It did that. And notice how the close, now when the close comes, it's too late because if price closes below or above the weekly open, while that's the best confirmation that you got it right for the week, the move's over. Your entry was up here. Your entry is not down here. Now, if you want to try to get in down here, you can, but I don't really teach that. Yeah, I want with the best possible entry with the smallest stop loss. And that entry is up here on Wednesday. It's not down here on Wednesday, okay? Because I'm not really a big on continuation trading. I like to trade near highs and lows if I'm long, okay? So let's take a look and see when price swept above Tuesday's high and started to close down inside of it, where we could have got in at. So this one right here was related to the 1:15 to 2 a.m. hour Eastern Standard Time. So a little bit before London, right when Asia ended. As you see there, price had a nice trend up. It did poke above it a few times, came down, and then again. So you could have got it. You might have got in a little early here and may have lost. This could have stopped you out. But don't give up on the pair if you get stopped out. Just stick with it because you could have just got right back in. Again, that's with risk management. And once you see the price start to break down inside the prior day high right here, boom, 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 those are your entries. Literally no drawdown once it does start to trend. And this could have been good for 1 to 5, for 1 to 10, okay, 10 to 50 pips, or even 100 pips. It's up to you. So, but a 10 pip stop loss on that one because it was right above the high of the day. Price went down through Thursday, as you can see here on the Thursday or the weekly chart. All this was Wednesday, and then this was Thursday. All that could have been yours. Friday didn't offer much. All right, so but that's that one. And then we have another midweek reversal here. And notice how Wednesday, okay, so remember, trading day is Wednesday. What do we want to see on Wednesday? If we're short, price to go above Tuesday's high and close beneath it. So even though Wednesday didn't close below the weekly open, like the one we just saw, as long as it closes below these highs, Monday's high and Tuesday's high, that's confirmation that, hey, look, price could keep going down. And it did through Thursday and Friday. All that could have been yours, okay? Because typically when you're trading midweek reversals, it should continue in the same direction on Friday. But again, that's not guaranteed because notice how Friday's candle opened. It went back up all the way here. Now your entry is here on Wednesday, so you're still good. But in terms of people trying to catch this trade, say if you wanted to catch a continuation here and try to enter like here around this low, you would have stopped out or possibly could have blown your account because Friday opened went all the way up here above the weekly open, and then tanked. So again, if we have to trade reversals, Wednesday is the only day. This is our little small entry open right here. So this is really the sniper entry aspect of the midweek reversal, where all you're doing is looking for Tuesday's high on Wednesday to be poked above and then close below. I don't know how to make it any more simple than that. Okay, but always pay attention to where each day closes. This day closed below right here. So as long as this close is below Monday and Tuesday, that's your confirmation. Okay, I think I got it right. This retrace shouldn't scare you because of the strength of this daily close. And then boom, price just tanked. So let's take a look at a smaller chart now. So this one, it really whipsawed, but it was still good. You might have dealt with a little drawdown here, but the best entry was between 9 and 10:30, where see how price just pinned it. Sometimes it'll pin the prior day high. It may not always close above it, but as long as it pokes it and then pins it, you'll see that you got 3 pins to the high right there. Your best entries were in the 9 o'clock hour through about 10 a.m. And again, you might have dealt with a little drawdown here as well. But again, you don't let this scare you because of the close. You got to wait though. You have to wait for this day to close, Wednesday to close. And once Wednesday closes beneath this low, beneath these highs, you're good if you're short. And same for longs. Okay. So, and then obviously it tanked. You could have got anywhere from 1 to 5 or 1 to 10 on that one. So that was another great trade there. So in conclusion, all you have to do is stick to the pattern and the plan, but always pay attention to the daily closes, as I just said. If price does not close above or below a weekly open, it should always close above the prior day high if you're going long, or it should be closing below the prior day low if you're going short. Okay. Always be careful if you scale in, because I want you to not over leverage. Okay. Risk management is what gets us paid, not trading. You could have the direction of the trade right, like for in a trade like this, but if you don't know how to manage your leverage, these pullbacks could take you out. Okay, something like this. If you just keep adding and adding and adding and adding and keep adding, when price pulls back like this, you're going to start to get margin warnings. Okay, so be smart. Try to keep your entries when you scale in closer together, so any type of drawdown doesn't blow your account. And then when price really starts to trend, you're going to see some tremendous profits. Okay, tremendous profits. All right. So 1 to 5 is always a good risk to reward. That would be the minimum that I would shoot for in this case. Don't expect to get a 1 to 10 every single week. Be satisfied with 1 to 5. So in terms of how to figure out your take profit and stop loss, base it on the stop loss, meaning that the stop loss should always go above the high of the day or below the low of the day if you're long, and then just multiply that by 5. So real quick, this one here was a 15 pip stop loss. 15 times 5 is 75. For this one right here, it was a 10 pip stop loss. 10 times 5 is 50. Easy enough. For this one right here, this stop loss, it could even gone below this low of the day. So let's say this was in theory, say like 15. Well, it was 15, but even if it was say 25, your stop loss was at 5 times, it would have been 100 pip take profit. All right. Because 25 times 4 is 100. So whatever your stop loss is, ideally you try to want to have it below the low of the day or in an area where you think price will not retrace back to. In this case, it was right here. But of course, hindsight is 50-50. Who knows? But the thing is this. You can really base your stop loss if you can't get it below the low of the day. Try to have it outside of the prior day low or outside of the prior day high. So see where this green line is? You're expecting price to stay inside this range is what you're doing. Okay, you're not expecting price to break back outside the range. So see when it pinned it and then took off? That's because you expect price to stay inside or above the prior day low. And the same thing for a short example. You're expecting price to stay below this red line right here. So your stop loss can be extra tight like that. But in this case, it was a little closer together. But in a case like this, you can base it on where the green line is. And you don't want it too wide, obviously, because you want this to be worth your while. But that's how I approach stop losses, either below the low of the day or outside of the trading range. I would say a big stop loss, I would say max, I would say 25. I probably wouldn't do anything above a 25 pip stop loss, to be honest, because some pairs have smaller average daily ranges. And if you have a 30 pip stop loss and you want to see price go up, 30 times 5 is 150. You want to see price go up 150 pips, but the average daily range of that pair is like, say, 50. That might be a tall order. It might not hit that. Okay, so you kind of have to, use discretion there and try to keep the stop loss not too tight, but not too big either. Okay, so don't over leverage is the main point of that. and your stop loss always goes outside of the range or below the low or high of the day. That's it. So I appreciate you watching. I appreciate your time and your attention. If anything doesn't make sense to you, definitely be sure to just rewind the video, take notes, take screenshots, do whatever you got to do, download the video, but just remember the patterns and the ranges and whatever day of the week it is. So this is really built from Monday through Wednesday. After Thursday, you're either taking your profit or you're letting the trade run. And Friday, you're not doing much of anything. Okay. But that's it. That's the whole deal. Thank you for watching. Have a great rest of your day. And credit to AM Trades for these screenshots because he did come up with the weekly expansion model. But of course, he got it from ICT. Everything comes from somewhere, so I want to be sure to give those guys their credit. Okay. But remember, stick to the plan, stick to the pattern, don't over leverage, and you'll be fine. And have a great rest of your day. Thanks for watching.